Here we go, we're back on. So using a average inventory system, average periodic inventory system, it's best maybe not to use a timeline, but instead to use a table. So we can set it up saying first column is our units, second column is our unit cost, and our third column is the total cost. So we began with 1,000 units at a cost of $5 each. So that gives us a total cost of $5,000. We purchased 2,000 units at $7 each. So that gives us $14,000 total cost. And once again, we're using a periodic inventory system. So this means we're going to save the sales for the very end. So we'll skip that first sale and go on to the next purchase of 3,000 units at $8 each, which gives us $24,000 for the total cost. Now that we have all of our purchases in our table, we can finally, or the next step is to figure out an average cost, an average unit cost. And the way to do that is to total up our total cost, which is $43,000, and to total up our units, which is 6,000 units, and to find a unit cost. Now, some of you might be tempted to just take an average of all these, but that's incorrect. You can ignore those numbers. The way to find out an average unit cost is to take the total cost divided by the number of units. So 43,000 divided by 6,000 is a unit cost of $7.16. There's our unit cost. We pretty much have said, okay, we have a bunch of units with different unit costs. So let's screw all these different unit costs and just say all of our units, which is 6,000 units, has an average cost of $7.16. So now that we sold 1,500 units and 2,000 units for a combination of 3,500 units. If you're wondering where I got that number, we sold 1,500 and we sold 2,000. Again, we're saving the sale for the very end. So we have a total sale of 3,500 units. So if we sell 3,500 units, we had 6,000, we sold 35, so we're left with 2,500 units. We're selling these 3,500 units at $7.16 each for the cost, not for the sales price, but the cost. So let's multiply that through. And that gives us 25,083. We have remaining 2,500 units at $7.16. So we'll multiply that through and get 17,916 with some rounding error. And there we go. So here is our ending inventory. These are dollar amounts. We have 2,500 units as ending inventory. They each cost $7.16. So here's our ending inventory amount. 25,083 is our cost of goods sold. And again, 43,000 is our cost of goods available for sale. So moving on to this table that we can fill out. It's asking us what the ending inventory was for our periodic inventory system using FIFO. Our ending inventory was $20,000. Our average periodic inventory was $17,916, and for LIFO it was $15,500. Our cost of goods sold using FIFO was $23,000. Average was $25,083, and LIFO was $27,500. From this table, you can see that FIFO gives us a large ending inventory compared to the other methods, but it gives us a small cost of goods sold compared to the other methods, and vice versa. LIFO gives us a small ending inventory and a large cost of goods sold, and the average is right in between the two. The gross profit for FIFO, think to yourself, is it going to be large or is it going to be small? Well, gross profit, remember, is revenue minus cost of goods sold. So FIFO has a really small cost of goods sold. So if we're going to have a small cost of goods sold, that means we're going to have a large gross profit. Average has, an in-between cost of goods sold, so it's an in-between gross profit, and LIFO has a really big cost of goods sold. So if we have a really big number subtracting from revenue, it's going to be a small gross profit. Moving on for here, which one is going to pay the most in taxes? Well, that's going to be FIFO, because FIFO has a really large gross profit, and after you subtract all your expenses, you're going to have a large income, which means the government is going to tax you more. Same thinking for LIFO. LIFO gives you a smaller income, so the government is going to tax you less, therefore you're going to pay less in taxes. And the same thinking continues on. FIFO gives you a large gross profit, so you're going to have a large net income, and LIFO gives you a small gross profit, so you're going to have a small net income. Okay, moving on to number 4. It's kind of going back to the original question. Let's figure out cost of goods sold and ending inventory using LIFO Perpetual this time. Perpetual means that we're going to constantly be updating our inventory numbers anytime a purchase happens or anytime a sale happens. So the difference is we're not going to save our sales to the very end. We're going to put them when they occur. So let's make a timeline again. We started with 1,000. We purchased 2,000. Now this is the difference. We sold 1,500. Then we purchased 3,000. Then we sold 2,000. So using LIFO, which is last in, first out, which units did we sell? Now maybe the best way is to kind of cover up the timeline. And okay, so we began with 1,000, we purchased 2,000. Now we have a sale of 1,500 units. Which units am I going to sell? Well, using LIFO, the last in are these 2,000 units. So I'm going to sell 1,500 of these units, so I'm left with 500 units there. We're done with that sale, so we can ignore it now. Then we purchased 3,000 units, and then we sold another 2,000 units. So which units am I going to sell with these 2,000? Well, using LIFO, last in, first out, these are my last in, so I'm going to sell 2,000 of these units. Therefore, I'm going to be left with 1,000 units there. So there's our timeline. Our cost of goods available for sale is the exact same as before, $43,000. Let's figure out our cost of goods sold. We sold 2,000 units from from these units, and these units cost $8 each. And we also sold 1,500 units from this group, which cost $7 each. So we'll multiply across, that's 16,000, and 7 times 1,500 is 10,500, which gives us a total of 26,500 as our cost of goods sold. Again, to figure out ending inventory, we can take cost of goods available for sale minus cost of goods sold, or we can just figure it out using the timeline. So we're left with 1,000 units at a cost of $5 each. We're left with 500 units at a cost of $7, and we're left with 1,000 units at a cost of $8. Multiply across, and that gives us, I believe, 16,500 as our ending inventory. And again, these are dollar amounts. Don't forget, you can also say cost of goods available for sale minus ending inventory gives us cost of goods sold. So if you have cost of goods available for sale and ending inventory, you can just subtract these and get cost of goods sold. Or you can flip it around. If you have this and this, you can figure out this. If you have two of the three, you can obviously figure out the third. There we go with inventory. Number 5, it's asking if beginning inventory is understated in the financial records, cost of goods sold will be overstated. True or false? The best way to go about this is to remember the relationship that beginning inventory has with cost of goods sold. So if you remember our beginning inventory plus our purchases minus ending inventory gives us cost of goods sold. If beginning inventory is understated, which means beginning inventory is too small than what it should be, cost of goods will be what? Well, if beginning inventory is small, that means cost of goods sold is also going to be small. So cost of goods sold is going to be understated. So this is false. Number 6, if a company understated ending inventory in the financial records, income taxes for the year will be what? Well, again, we can just remember this relationship. Beginning inventory plus purchases minus ending gives us cost of goods sold. Now it's saying ending inventory is understated. How will that affect income taxes? This one's going to be, we're going to be jumping through some loops, but hold on tight. So ending inventory is understated, which means cost of goods sold will be overstated because we're subtracting a small number. If we're subtracting a small number, the cost of goods sold will be larger. Now, if cost of goods sold, remember revenue minus cost of goods sold gives us our gross profit. So if we're saying cost of goods sold is overstated, what does that mean for gross profit? That means gross profit is understated because we're subtracting a large number. If we're subtracting a large number, the answer will be smaller. And then we subtract all our other expenses, which gives us our income before taxes. How will that be affected? Well, if we have a small gross profit, that means we'll have a small income before taxes. And then we multiply that by the tax rate to figure out how much we owe in taxes. If we have a small income before taxes, that means we'll have small taxes to pay. Or in other words, our taxes for the year will be understated. Because we have a small income, therefore the government is going to tax us less. Hopefully you were able to follow that. Number 7. We've got cost of goods sold, beginning and ending inventory. Let's find our inventory turnovers and these other ratios. So inventory turnover is cost of goods sold over average inventory. So simply our cost of goods sold is 50,000. That's our numerator. And our denominator is the average between beginning and ending. How do we do that? Well, you just take a simple average, add those up, divide by 2, and it should be 17,500, if I'm correct. There we go. Divide that out. You should get about 2.86 as our inventory turnover. That's the amount of times that inventory is turned over, or in other words, the amount of time, or the amount of times a year that inventory is sold. It's kind of a confusing ratio, so to simplify this, we use days in inventory. Now, days in inventory, we just simply take 365, the number of days in a year, divided by inventory turnover, which is 2.86. And we get 127 days, 127.6 days, about. So that means inventory is sitting in our warehouse for 127 days on average. So conceptually, think to yourself, would you want a large or small days in inventory? Usually you would want a smaller days in inventory, because the faster inventory is moving, the more money you're making, and the less waste of time your inventory is taking. All right, so that's inventory. We're moving on to bank reconciliations. The question, we've got a bank reconciliation for Amazon. We're Amazon for the month of November. All errors are made by Amazon. Okay, so we've got a few deposits in transit and outstanding checks from last month. And then here's our bank statement, and here's the book's records, Amazon's records. So let's start cash balance per the bank. So the bank has 86,959 according to the bank. Before we go into that, let's maybe talk about why we're reconciling. So our books say that we have $84,000. The bank says we have $86,000. So obviously we want those numbers to match, because we want to make sure that our records are right and to make sure that the bank is correct. So there's some reasons why these two numbers are different. So we're going to figure that out, why they are different. So the bank has 86,959. We're going to add, let's see. We're going to add any deposits in transit. So a deposit in transit is when Amazon deposits a check to the bank, but the bank hasn't recognized it yet. So we have a deposit in transit from October. Let's ask ourselves, is it still in transit? And we can see, no, it is not. We have a $10,000 deposit according to the bank, so that is no longer in transit. How about any of these deposits? We've got a $20,000 deposit. We've got a $20,000 deposit there, so that is fine. We've got a $30,000 and a $30,000 there. That is also fine. And we've got a $15,000 deposit, nowhere to be seen on the bank statement. So there is our deposit in transit for $15,000. We're going to subtract any outstanding checks. An outstanding check is when we pay someone, or when we give someone a check, but they haven't cashed it yet. So we know we've paid someone, but the bank doesn't know that we've paid someone. So we need to subtract any outstanding checks from the bank. So we've got an outstanding check for $5,000 from last year. It looks like the bank has seen it, so it is no longer outstanding. We've also got a $55.50 outstanding check. The bank still has not seen it, so that is outstanding still. Let's check on these. So we've got check for $50,000. The bank has seen that one, so that is not outstanding. We have an $88,800 outstanding check. That is outstanding. We will take that out. And we've got a check for $914. The bank has seen it, but it is an error, so we will come back to that later. But that is not outstanding. So there's two outstanding checks. So we will add that up. $86,959 plus $15,000 minus our outstanding checks gives us an adjusted cash balance for the bank of $87,609. Moving on, we've got our cash balance for the books. Our ledger tells us that we have $84,736 according to the books. We're going to add any EFTs. In this question, we don't have any EFTs, but we would add an EFT, an electronic funds transfer. We're going to add interest revenue